Hello guys, welcome back. So in this video we're going to look at some very important market concept that every trader needs to understand. So the first one is PEEP. PEEP is the measure of the movement of a forex pair. It's like the SI unit of the forex market. So forex pairs, they move up or down at any point in time. So PEEP is what helps us to be able to measure how far, okay, the market is moving. So we're going to look at that using the Untitled Trader 4. So afterwards we look at the lot size, the leverage, and of course the margin. So let's go to the Untitled Trader 4 now. So this is the Untitled Trader 4, and I'm still using the Euro US dollar currency pair, and this 1 hour time frame. You can see this is the market and price is moving up and down. Currently price is at 995, that's 1.0995. So let's now look at how we can measure our price pips. So let me pick this this drawing tool here, which is the horizontal line drawing tool. Okay, and let me try to find the number of pips that are covered between one level and the other. Let's pick this level first and this level. So the first level is 1.1014 and the second is 1.0966. So we want to determine the number of pips between these two levels. So the best tool for this on the Untitled Trader 4 is the crosshair. So you click on the crosshair, you come to the first level, all right, you click and hold and then drag to the second level. So at the second level you will stop. Now you have three information there. One is saying 3, one is saying 48, 480, and the other one is giving us some numbers. So the first one is telling us the number of candles between the first level and the second level, just the way I've drawn it, while the second one is telling us the number of pips, so which is 480. But in this case it's going to be in one decimal place. Okay, one decimal place, so that's going to be 48.0, which is 48 pips. So that means between those two levels you have 48 pips. Let's look at another one. Let's say this price level here, this one, and this one here. So between 1.1044 and 1.096, you want to determine the number of pips. So I can come to the first level, anyone, you can start with anyone. I click, I hold, and I drag to the second level. So how many pips is that? That's 78.2 pips. So there are 78.2 pips between these two levels. So that is how you measure the number of pips between these two levels. As time goes on, as we go further, you are going to see the implication of this. All right. So away from that, let's look at the lot size. Lot size is the quantity of transaction that is made. Now in every market, you will always, whether you want to buy or sell, there is always the aspect of the quantity of what you want to buy. Okay, so the quantity will now be multiplied by the unit value of that item. Okay, the same thing here. The item here is the exchange rate of a currency pair. All right, and it is very important that you choose the size of your trade, and that is called the lot size. Okay, so in the forex market, the name is called the lot size, and one standard lot size is equal or is equivalent to 100,000 units of the currency pair. So let's look at Euro US dollar. But how do we now calculate the value of that transaction? So the value of that transaction, just like every other item you buy, is going to be the number of units, okay, multiplied by the value of 1 unit. Okay, so if one standard lot is 100,000 units, then the value of one lot is going to be 100,000 multiplied by the exchange rate. So the time as at the time this video was prepared, the exchange rate for Euro US dollar was 1.0985. So if you multiply that by 100,000, you get $109,850. So which means that if you want to open a trade, one standard lot on Euro US dollar, that's how much you have to deposit as what we call margin. So that takes us now to margin. So margin is how much a trader needs to deposit in order to open a transaction, and it is calculated like this. All right, that's how much you have to deposit in your account before you before you open this kind of trade. So that money is going to be held until your trade is completed. Okay, so That's this a whole lot of money, right? But of course you can buy the smaller size of this. This is one standard lot. You can buy multiples of it. You can buy up to 50 lots at once. Okay, at once you can buy up to 49, 50 lots, and then that's of course if you're a millionaire in dollars and all that, so you can buy a lot of the. But if you don't have so much money, you can of course buy the micro lot, 0.01 lot to 0.99 lots. So that's what we have for micro and mini lots. Okay, so that means the minimum lot size you can open, okay, you can trade is 0.01 lot. Okay, so 0.01 lot. Okay, so let's now look at the value of 0.01 lot of euro US dollar at this rate that I used. And so that's going to be 0.01 multiplied by this value, and then you get this. Okay, so that means 0.01 lot is this. That's the value, the margin for 0.01 lot. Why this is the margin for one standard lot. So the calculation goes on and goes on. So you can have 0.02, 0.25, 1.25, just from 0.01 to up to like 50 at a time on MetaTrader 4. Now with all this, even with 0.01, this looks very, very big, okay, for a whole lot of people. And that is why leverage is now being introduced, which means that you can borrow a whole percent, a bulk percentage of this margin size. Okay, you can borrow a whole lot of it from your broker. Okay, so let's look at how that works. Okay, and that is what we call leverage. Now currently Greenwave Exchange offers 1 to 500 leverage. Okay, so what is the implication of trading with leverage and trading without leverage? Now, when you trade with leverage, which is up to 1 to 500 for Greenwave FX, what it means is that the real value of your transaction, or which is the supposed margin, okay, on your particular trade, will be divided by the leverage. Okay, that will now give you a leveraged margin. Okay, now these two examples, okay, were the examples that we used, that we just used. So this one is for 1 lot of euro US dollar, and this one is for 0.01 lot of euro US dollar. And these are the margin. Okay, that means how much you need to deposit before you take this trade. Now let's now look at this different margin that you can choose. Okay, if you trade with Greenwave, so 0, 1 to 100, 1 to 200, 1 to 500. So what this margin is going to do is to divide this what this leverage is going to do is to divide this initial margin. So if you use 100 to divide this, you get this. 200 to divide this, you get this. 500 to divide this, you get this. So that means if you choose 1 to 500, for example, a transaction that normally worth this, if you have $219.7, you can trade it. Okay, so that's what it means. That means you are borrowing how much now? That's over $109,600. You are borrowing it, okay, from your broker to take charge of one standard lot, okay, to take charge of this transaction. All right, and when you come down even to the micro lot, which is 0.01, with 1 to 500, instead of paying nearly $1,100 with just $2.2, you can take charge of that as well. And that is why, number one, the forex market can be traded by anyone. Okay, because with $2, with $3, one can open a trade. Okay, and also that is why the forex market is very, very lucrative, because on a normal day, what you're supposed to open with $1,000, you are now opening it with just $2, and whatever profit you make is going to be calculated based on this and not this. Okay, but leverage is a two-edged sword. While it can magnify profit, it can also magnify your exposure to risk. Okay, so the concept of margin and leverage is very important for every trader. And then I also need to mention that as you continue to open trades, more margin is going to be tied down from your account. So let's say, for example, you have $100 account and you open 0.01 lot, okay, of euro US dollar, which, let's say you choose 1 to 100 leverage, that's going to be $10. So if you open this, that's going to be around $11. if you open this trade, before you open that trade, the margin you have on your account is $100, which is your real money. But if you open this trade, which is like $11, while the trade is going on, your margin will now be reduced to 100 minus 11, that's $89. So that means the next time you want to open another trade, the market is going to consider what you have left as your margin, not what you have left as your capital. So that's why traders should make sure that they don't over leverage their account. Okay, they don't also they also need to make sure that they watch their margin level, okay, in order to avoid what we call stop out or what we call margin call. Because once you exhaust your margin level up to a certain degree, certain level, your broker is going to warn you to watch your margin. That's what we call margin call. Okay, so that's it about margin, that's it about leverage, that's it about lot size, and that's it about pips. Okay, so gonna see you in the next one. Thank you.